Welcome back to the channel. Today we're diving into one of the most overlooked but incredibly powerful strategies in personal finance and investing: asset location. Most people spend all of their time thinking about what investments to buy, but they ignore where to hold those investments. And trust me, where you put your money, whether in a taxable account, a tax-deferred retirement account, or a tax-free account, can make the difference between retiring comfortably and running out of money. By the end of this video, you'll understand how asset location works, why it matters, and exactly how you can use it to keep more of your hard-earned returns. So, let's start with the basics. When people hear asset allocation, they usually think about how much of their money goes into stocks, bonds, or alternative investments. Asset location is different. It's all about which accounts you place those investments in. You might have a taxable brokerage account, a tax-deferred account, like a traditional IRA or a 401k, a tax-free account, like a Roth IRA. Each of these accounts comes with its own set of tax rules, and those rules dramatically change how much money you keep after Uncle Sam takes his cut. If you put the right investments in the right accounts, you can boost your after-tax returns without taking on more risk. Let's talk about why this matters. Let's say you and your friend both invest in the same portfolio. You both earn the same pre-tax returns. But if your friend ignores asset location while you optimize it, you could end up retiring with tens of thousands, or even hundreds of thousands more. That's because taxes act like a slow leak in your financial bucket. Every year, that leak drips away money that could have been compounding. By plugging that leak, you keep more of your money working for you. That's what asset location is all about. Here's the golden rule. Tax-inefficient investments belong in tax-advantaged accounts. What do I mean by tax-inefficient? Think about investments that throw off a lot of income, especially income taxed at your ordinary income rate. That could be high-yield bonds, which produce big interest payments; private credit, which often distributes income regularly; hedge funds, which may generate all kinds of taxable events throughout the year. If you hold those in a taxable brokerage account, you'll get a tax bill every single year, and that tax bill chips away at your returns. But if you hold those same investments inside a retirement account, like a traditional IRA or 401k, you defer the taxes until withdrawal. Or inside a Roth IRA, you may avoid those taxes altogether. So the first big principle: shelter your tax-inefficient investments in tax-advantaged accounts whenever possible. So what belongs in taxable accounts? Generally, investments that are naturally tax-efficient. Think about broad market index funds, ETFs that have low turnover, municipal bonds, which can be federally tax-free. These types of investments don't generate a lot of taxable events year to year, so they're perfect for accounts where you want to minimize the tax drag. Now let's talk about a strategy that works specifically in taxable accounts: tax loss harvesting. Here's how it works. Let's say you bought an investment for $10,000. Now it's worth $8,000. Most people just hold it and hope it comes back. But if you sell it, you lock in a $2,000 capital loss. Why would you want that? Because you can use that loss to offset other capital gains in your portfolio. And if your losses are bigger than your gains, you can even use up to $3,000 a year to reduce your regular income. And here's the key: you don't have to sit in cash after selling. You can immediately reinvest the money into a similar but not identical investment. That way you stay invested while capturing the tax benefit. Over time, tax loss harvesting can save you thousands of dollars in taxes, which again keeps more money compounding for you. Another key concept in asset location is aligning your time horizon with the right type of account. Here's what that means. Short-term needs, money you'll need in the next 1 to 5 years, probably doesn't belong in a retirement account, because pulling it out could trigger taxes and penalties. It's better in a taxable account where you can access it freely. Medium-term goals. Maybe you're 10 to 15 years away from needing the money. A mix of taxable and retirement accounts could make sense, depending on your situation. Long-term retirement savings. This is where retirement accounts shine. Since you won't need the money for decades, you can take full advantage of tax-deferred or tax-free growth. Matching the right account to the right time horizon ensures you're not only optimizing for taxes, but also for liquidity and flexibility. Let's put all of this into a simple example. Imagine you have 3 buckets. 1. A taxable brokerage account. 2. A traditional IRA. 3. A Roth IRA. Here's how you might think about it. Put tax-inefficient investments like high-yield bonds or private credit into the traditional IRA, where the income won't be taxed until you withdraw it. Use the taxable account for tax-efficient investments like index ETFs and practice tax loss harvesting when opportunities arise. By following this framework, you're maximizing after-tax returns, minimizing tax drag, and ensuring your money is in the right place for your goals. Now let's quickly cover a few mistakes investors often make. First, ignoring asset location entirely. People just throw investments into whatever account has room. That's like playing chess without thinking about strategy. Second, chasing tax savings without considering liquidity. Remember, you need to be able to access money when you need it. Don't lock up short-term funds in retirement accounts. And third, overcomplicating things. Asset location is powerful, but you don't need to turn it into a spreadsheet nightmare. Even a few smart decisions like putting bonds in an IRA can make a big difference. The beauty of asset location is that it doesn't require you to take on extra risk. You're not gambling on which stock will go up. You're simply being smarter about where you hold your investments. Over 20 or 30 years, that can translate into a retirement portfolio that's hundreds of thousands of dollars larger. And here's the best part. Once you set up a smart asset location strategy, it mostly runs in the background. You don't have to constantly trade or monitor it. So let's recap the key points. Put tax-inefficient investments, like high-yield bonds, private credit, and hedge funds, into retirement accounts. Keep tax-efficient investments, like index funds and municipal bonds, in taxable accounts. Use tax loss harvesting in taxable accounts to capture losses and reduce your tax bill. Match your time horizon to the right type of account to avoid penalties and liquidity issues. And above all, remember that asset location is about keeping more of what you earn. If you follow these principles, you'll be setting yourself up for stronger after-tax returns, more flexibility, and a smoother financial journey. If you're finding this video helpful so far, don't forget to hit the like button. It really helps the channel. And if you want more videos like this, make sure you subscribe so you don't miss future episodes. Now, I want to hear from you. Have you thought about asset location in your own portfolio? Do you already place certain investments in certain accounts, or is this something new you're considering? Drop your thoughts in the comments. We'd love to hear your perspective. Thanks for watching, and we'll see you in the next video.